Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. That's right. My name is Mark Eitel. This is the Mr. Mortgage Show, and we do put the fun in funding. And you, my friends, are in the right place if you want the information and the data that you need to make better real estate and mortgage decisions for you and your family. And I know there's a load of headlines swirling around out there, and it's our mission to dive deeper into the data, past the headlines, and give you the real scoop. So we're going to answer your questions. If you have questions, we're going to encourage you to shoot them over to us. You can do that via the Anytime hotline. That number is 561-291-8569. That's 561-291-8569. Dom, the producer extraordinaire, is manning the hotline. He'll get your questions on the air. And if you want to get on the air with us, you can just call that number. He'll get you on the air. So that's 561-291-8569. Or if you're more comfortable doing it via the web, the website is mr.mortgage. That's mr.mortgage, never a .com. Just type in Mr., hit the dot, type in mortgage, and then hit enter and watch what happens. We will pop up on your screen, and there's a contact us box there, upper right-hand corner of the website, and you can type your question there. We'll get it on the air that way also. So as I mentioned, we like to dive deep past the headlines and really kind of focus on the data that's making up this crazy housing market that we're in. I'm getting tons of questions every day. Are we in a bubble? Is the bubble going to burst? What's happening with interest rates? What are interest rates going to do to the housing market? And, everybody's kind of cautiously watching. Last year, everybody was running hand over fist into the market. And at the moment, everybody's really looking for the milestones and the indicators in the economy to make sure they're making the wisest decision. And we're going to try to help you with that. So some of the headlines this week I found really interesting. A lot of buzz around the fact that mortgage application activity and funding activity has fallen significantly. And some of the headlines, there's slight variations to the actual data, but they're saying about 32% year over year, which is the fastest decline in 8 years, in the lowest activity that we've seen in 22 years, which you would think for a guy like me is horrifying, but it's not. It really isn't. And we're gonna touch on that data here in a minute. Another thing I found super interesting was the areas that are predominantly second homes. So think of coastal vacation towns and things of that nature. Second home prices surged both in the sales volume and the price. Both in rental growth and in sales price growth, 25% year over year. So that was really interesting that second home destination property, if you will, is still in high demand. And then another article I read, Cash is King. We're seeing people pool their money together to buy. Maybe a father and a son, or parents and children are pooling cash together so that the child is able to, or the parent, I guess, able to buy for cash to make their offer super competitive. And then we as lenders have a program for that called, what is it called? I can't believe I'm forgetting this. It's called delayed financing. There we go. I just remember. I need a second cup of coffee, Dom. Delayed financing allows you to pull your cash back out without paying the slight rate increase or the same underwriting scrutiny of a cash out refinance. So that I found interesting, that cash is still kind of, super important in this market, although we're seeing mortgaged offers being accepted at a higher rate. And I'm going to touch on that too, because we are seeing some very encouraging trends as far as buyers and sellers willing to work together to make a deal happen. I've had some really cool success stories this week that I'd like to share with you. And one last thing, I thought this was kind of a fun article, and I'm going to read this headline, and then we're going to dive into the article itself. But it says, pain points. 62% of respondents to this survey said the process of preparing their home for sale negatively impacted their mental health. And 63% of people, so one more percentile, said they considered taking their home off the market during the process because of all the stress surrounding it. So another reason why a good real estate agent might make a difference in a transaction. But we're going to go into that because that's actually quite a fun article. So let's dive into that mortgage article. So it said mortgage applications, the activity falls to the lowest level in 22 years. So super, super negative headline, right? And if you've driven in and seen gas prices at nearly $5, like I just did this morning, and the grocery bill is still out of control, and the stock on the shelves is bare for a lot of products. I mean, inflation is here. So we're all super concerned about the economy, and housing still remains one of the most talked about parts of the economy, if you will. So you read that and you say, okay, mortgage demand has fallen to the lowest since 22 years. And your mind flashes back to the early 2000s and you think, okay, here we go. This is the start of a bubble burst. But here's what I found really interesting, that 75% of the downturn is in the refinance market. Now, if you think about that, there's no real surprise there because we just came out of the longest and lowest, the historic lowest interest rate environment we've ever had. People were borrowing 30-year money in the high twos and low threes. I mean, that's if you factor in, true inflation and true economic growth, that's free money. So we just came out of a cycle where for about 18 months you could borrow at a rate lower than you ever could in your lifetime and ever could in the history of mortgage rate tracking. It makes sense that as rates have normalized into the fives, that 75% of that demand is gone. The surprising part of that is there's still 25% of that demand still there for refinances. And we're going to touch on that too, because there's a portion of the economy, of homeowners rather, that are suffering from this economy that are actually doing cash out refis for a reason. And we're going to touch on the rec loan and how to maximize the cash out to reduce your debt. So I found that interesting. But what was really, really compelling about that article was that refinancing still makes up a majority of the mortgage application activity in Q1 of 2022. So historic rates are behind us. We've moved into an environment where rates are in the fives, and 53% of mortgage applicants are still doing refis. Now, this is Q1 data, so I know that that is going down as we move, word towards the end of Q2 at the airing of this show. So that data is on the way down, but still 53% of people applying for mortgages are doing a cash out refinance or a rate and term refinance, which I can't imagine at 5.5% there was anybody left for rate and term. But nonetheless, I found that super, super surprising. And if you dig deeper into the article, it said actual purchase mortgage percentage was up. Purchase mortgage applications were down a little bit, but they reference the tight supply. There's just not enough housing inventory. So the purchase volume is down by a byproduct of that. It's not solely because of interest rates. And I'm not discrediting the effect interest rates are having on the buyer pool, because there are first-time buyers who have been priced out of the market. And now the double whammy of higher rates and higher prices, it is influencing them, no doubt. But still, purchase activity is up as a percentage if you read the data. So super interesting. I just share all that because if you read that headline, you see that 22-year date, you see lowest in the last 22 years, and you immediately, and it's logical. I'm not knocking anybody for assuming that. It's easy to assume, and I believe it's the purpose of that headline is to get you to read it. But it's converse to the headline. The data's different. It's not bad news. It really isn't. The market's stabilizing. We're seeing buyers and sellers willing to work together to make a deal, and the home values are still supported at these levels. So super interesting market that we're in. We just don't have enough supply to put pressure on pricing. And I pulled a chart, and I'll post it on the Facebook page because I found it pretty interesting. But I pulled a chart that shows the interest rate versus sales volume. And I went back to the bubble bursting years because that was my major focus. And you'll see that in interest rate environments in the 8s and the 6s, we're still experiencing year over year growth in sales volume. So I share all that just to encourage you not to be frightened by the headlines, because you can be frightened into inactivity, and inactivity can cost you tens of thousands of dollars in equity wealth. I mean, look at the people who could have bought 2 years ago and waited, could have bought last year and are still waiting. If they wait another year, where are they going to be? So hopefully you find that encouraging. You hear the music behind me. That means we're going to roll into a break. We're going to be back in 2 very, very short minutes to take all your questions. Dom and I are here. We'll get your questions on the air. We'll be right back. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel, and you heard the man, 561-291-8569. Get your questions on the air. You can call or text that number, 561-291-8569. And if you don't want to get on the air, just tell Dom. He'll take your question down and read it to me. So super excited to get to those questions. But before I do, I just wanted to finish up the data. So you heard me mention that there's still a tremendous amount of pressure on supply, meaning more people still want to buy, even in the face of mortgage applications falling, even in the face of increasing interest rates, even in the face of $5 gas, $7 bacon, all the craziness we're facing. Here's a statistic from that article. 54% of homes that went under contract had an accepted offer within the first 2 weeks. 39% of all homes that went under contract were under contract within a week. I mean, those numbers are still crazy. So until there is enough supply to offset this demand, I really think, as uncomfortable as it is at these prices, there's a strong footing to support the level that we're in. So you've heard me say it all the time, and I'm going to throw you or push you rather towards the Facebook page. Hit Facebook and search The Mr. Mortgage Show. There's a ton of data. We put up new articles and new data sets every day that support these positions that I share each week on the show with you, because I want you to have this data. Full transparency. This isn't just my random opinion over a beer at the end of the bar at the VFW. This is really, data-driven decisions that we're trying to encourage. So we're posting that there for you. So anyway, I thought that was interesting. And then I touched on the fact that one article that I mentioned was kind of funny, and I wanted to dig into that. I didn't want to leave you hanging on that. So that article that said, the pain points of selling a property, that was published by OfferPad. And I don't know if you're familiar with OfferPad or not, but they're like well, who's the big one in our area? We Buy Ugly Homes, right? They'll come in and make you a cash offer, buy the house direct. You don't have to put it on the market. You don't have to use a real estate agent. Although I'm not a proponent of services like that in an environment where, it's easy to sell a property, meaning there's a lot of demand for property. So you're going to get the most amount of money by putting it on the market and offering it to the public. There is a place for the offer pad type companies out there when you need a fast sale, when you're willing to take a discount just to make it fast and convenient. So full disclaimer, not a fan of going the offer pad route in a market like this, but I do see the value in the service that they provide overall. So I wanted to share that because they have created a great marketing campaign around that stressful buyer questionnaire, the results that they got back from that. So 25% of the people that responded to their survey said managing their pets was the number one concern when selling a property. Open houses, showings, they're trying to figure out what to do with the dogs and the cats, which is interesting. I thought that might be a little higher, but it might be because there are a lot of pets in my neighborhood. I'm not sure. Getting their family out of the house, 22% of the people said that was a problem for them. So OfferPad created this Bush Family Disguise program where they'll send you these bush costumes for you and your family so you can dress like bushes and wait the open house out by sitting in your backyard and looking like part of the landscaping. So I thought that was a brilliant marketing strategy. Big kudos for them. 31% of respondents said organizing their closets and their cabinets was their major concern. So OfferPad created a magic closet cleaner program where they give you a shade that pulls down in front of the closet door, and on there is printed an organized closet. So I might take them up on that. That might be an easy way for me to organize my closets. But lastly, I'll touch on this. 28% of the respondents said they bake something fresh, either cookies or an apple pie, before an open house. So the house smells like, home that you remember from your youth. But anyway, they offer you the Spray Your Way to Sold fresh baked cookie air freshener that you can spray the house with. So brilliant market strategy, although I still think a rock star real estate agent is the way to go. And I do want to share this. This just popped in my mind. I work with one particular agent that just popped in my mind, and he's a rock star. And when he does an open house, he gives the family a 4-pack of tickets to the movie theater and a gift card to Outback. So Top Gun and Bloomin' Onions were on the roster this last weekend, and he was able to do an open house and sent the family out for an afternoon of relaxation and dinner, or lunch, whatever. But anyway, we're going to keep the show rolling. I'm going to throw it over to Dom and see if we have any questions teed up.
Anna sent over this one. Anna is asking, I talked with a lender who said I need to have a 690 credit score to get a mortgage. Is this true? I'm not a first-time buyer, if that matters.
Hey, Anna, that is a great question. It's not true. It's not. And I've heard this a few times lately. You can get a mortgage with a credit score down to a 580. 620 is kind of the threshold that opens up a variety of programs for you. So no, 690 is not, required. And first-time home buyer or not, there are a ton of programs available in a much lower credit score. And, a 690 is a really good score. 620 is nothing to be ashamed of. We can get you a mortgage with that. One thing that might be happening is, and I don't know this, and I welcome the opportunity for a conversation, they may be underwriting you to a very specific loan program that requires a 690. But as a general rule of thumb, there are a ton of programs available with scores lower than 690. So I hope that helps. If you want to dive deeper on that, just give me a shout during the week, 561-291-8569. That number pushes to my office when Dom and I aren't here on the air. So I'm going to throw it back to Dom for another one.
Brett wants to know, what's the minimum documentation for an investment property mortgage? I'm self-employed. I show losses. I'm looking for a hassle-free loan. Any tips?
Hey, Brent, that's a great question. So in the old days, if you could fog a mirror, you could get a loan, right? But no, there are some low documentation loans primarily for investment property. So you might find it helpful. You hear me talk about the DSCR loan, and DSCR stands for Debt Service Coverage Ratio. So we're looking at the property. We're putting a lot of weight in the underwriting decision on the rental income that the property generates. So if the property pencils, which is an industry term, but if you're an investor, you know what I mean by that. By pencil, I mean cash flows. The property will pay for itself. You can go to as low as a 0.75 to 1 ratio, but we're looking for at least a 1 to 1 ratio in most instances. You can get away with a loan application. You can leave the income fields blank. Loan application and bank statements. 12 months worth of bank statements is typically the minimum. We may need 24 depending on your occupation. And we're looking for stability in cash flow. We're looking for the cash to close as well as reserves. And then we're looking at rent rolls on the property. So assuming the property pencils and you have decent credit, we'll just take your bank statement. So I hope that helps. That's about as hassle-free as it gets right now. There are some no income, no employment documentation loans. They typically require a larger down payment, but we can talk about that too if you have any interest. Just give me a shout, 561-291-8569 if you need more info. But in the meantime, I'll throw it over to Dom and see if we have another question.
We do. Sandy sent in this text. She asked, I've been renting forever. I want to buy a little place for me and my daughter. I just don't know if I should wait. Do you think rates or prices will come down?
Wow. I wish I had the crystal ball, Sandy. I really do. My personal beliefs are based on spending far too long dissecting the data every day, really. I mean, I can't tell you how many times my legs go numb when I'm sitting in the porcelain library reading an article. I guess I probably shouldn't have admitted that on the air, but nonetheless, I spend a lot of time in the data each day. So I personally think we're here for a while. Price-wise, I don't see an interest rate reduction in the future. Now, that being said, if we go into a full-blown recession and the Federal Reserve and the monetary policy is eased and rates pull back, there may be a rate reduction. But hey, keep in mind, you can go find the dream home today, but you don't have to have the dream loan. It doesn't have to be the forever loan. You can refinance at any time, and you can do a term-specific refinance. So let's say you buy today and have a 30-year loan, and in 3 years you want to refinance. We can do a 27-year term or a 23.5-year term. So you can do a term-specific refi. So you'd be buying at today's price, locking it in, and you can handle the interest rate piece of it if they go down later. So hopefully that helps. I hear the music behind me. That means we're into a break. We'll be back in 2 very short minutes to take more of your questions. Thanks. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. You are listening to the Mr. Mortgage Show, where it is our goal each week to give you the information you need to make better real estate and mortgage decisions for you and your family. And if you have specific questions, please give us a call, shoot us a text to 561-291-8569. That's 561-291-8569, and Dom will get your question on the air. Or you can visit the website, mr.mortgage, never.com. Just type in mr.mortgage, and there's I think it's a contact us button on the upper right-hand corner of the page, and there you'll be able to submit your question. And just to finish up one thought on Sandy's question about should she wait because rates and prices have her frightened. I talked about the ability to refinance for a very specific term, so you're not adding to how long you have the payments in your future. But I just wanted to throw out that, right now today, and you hear me talk about it all the time, there's the video on the Facebook page explaining supply and demand. Right now, there's more demand than supply. So if you're able to buy something now, it makes sense from a budget standpoint, and it's a home that you want to raise your daughter in, I certainly encourage you to take that step. And if you're still hesitant and you want to take some time and talk through it, give us a call during the week. Ask to speak to me directly. We'll figure it out. And no pressure. I'll just give you the information, show you some of the pros and cons of making that step, because it's a huge commitment and you should take the time you need to get comfortable with it. Just don't sit on the sidelines because of uncertainty based on the wrong news, I guess is where I'm going with that. So supply and demand is what you want to look at. That's what's going to push pricing, not necessarily just interest rates. So hopefully that helps. I wanted to take a little extra time with that because, it's not uncommon. Sandy's a first-time buyer. She said she was renting with her daughter. So that's a big step. I'd be happy to walk you through it. So let me throw it over to Dom for another question.
We have Joan and Thomas who emailed us. Joan and Thomas were asking, how soon after we purchase can we qualify for a reverse mortgage?
Wow. So that is a great question. You might have stumped Mr. Mortgage. So I don't know off the top of my head. You can't see me because we're on the radio, but I'm scratching my head. I'm massaging my thinker. I don't think there's a time limit, but I do want to throw this out there. Why not use a reverse mortgage to make the purchase, and then you don't have to wait at all? That's a very little known feature, and a lot of the mortgage professionals who provide the reverse mortgage service don't exactly know how it works. And I'm not going to mislead you. We don't do a ton of them. Most reverse mortgages are for people who already own their home, but we do reverse for purchase also. And how that works, I'm going to use some very round numbers, and then I'm going to encourage you, if you want more information, to give me a shout during the week. But let's say you're in the big house, you raise the kids in, and it's worth $500,000, and you don't have a mortgage, and you want to move to the cool new 55-plus neighborhood with the golf club and the tennis courts and the active lifestyle and the bus that takes you to the mall and all the cool parts of living that lifestyle with other people in your age group who want to age in place. So let's say it costs the same amount of money to get into the new neighborhood. So you sell the house you raised the family in for $500,000, and you go to the new neighborhood, and let's say it costs $500,000 to move in there too. So you can spend your entire $500,000 and trade like for like, and you put no money in the bank, and now you have the burden of the higher taxes, probably association fees, probably a higher insurance rate because this is a more, maybe not a higher insurance rate because it's newer construction, but I'm assuming that your taxes on your property that you currently own are less. So what I'm saying is the ancillary costs of ownership on the new house might be higher. So you've just put all of your money into that property, so you have no more monthly cash flow, which is the big benefit of a reverse mortgage. And that's why I'm guessing you're asking about it. So I want to share this. You could sell that $500,000 house, and these are round numbers. It's all going to be age specific and property specific, but it's going to be somewhere in this neighborhood. So you sell the house for $500,000, you put $250,000 in the bank, you put $250,000 on the new purchase, and get a $250,000 reverse mortgage that requires no mortgage insurance. There's no principal. There's no interest payment each month. Now, you do still have to pay your taxes, and you do still have to pay your insurance. And if there's association dues, you have to pay those. But the big chunk of your payment, principal and interest on $250,000 in this example, you don't have to pay. So a reverse for purchase may be the way to go for you, Joan and Thomas, because if your thoughts are you want to pull that money back out as soon as you can, I'm guessing that your scenario might be similar to what I just explained. So if that's the case, a reverse to purchase might be worth a conversation. So I encourage that conversation. If you're open to it, just give me a shout, 561-291-8569. And, math aside, that works for just about anybody who is in a circumstance where they're pulling a big chunk of equity out from the sale and they want to move, but they don't want to put all that money back into a new property. So food for thought, reverse for purchase is a thing. It's not the Loch Ness Monster. It's not Sasquatch. It does really exist. We do them, and I'm happy to walk you through it. So hopefully that helps. I encourage you to give me a call during the week so we can talk that one through. But in the meantime, we're going to keep the questions coming. Let me throw it over to Dom.
Sammy sent in this text. Sammy is asking, I think we're in for a serious recession, and I want to pull out some cash now. I'm leaning towards an equity line. Any advice on an equity line versus a cash out refinance?
Hey, Sammy, you are not alone, and I'm guessing it's Sammy, Mr. Sammy. I don't know, but you, my man, are not alone. If it's Mr. Sammy, if it's Mrs. Sammy, you, my dear, are not alone. But there are a lot of people who feel the same way that you do, and let me say this: whatever you're going to do, HELOC or cash out refinance, do it sooner rather than later. And what I mean by that is, too often, if people are really moving towards an economic hardship or the necessity for additional expenditures, if you wait too long, your credit worthiness might be compromised. And by that I mean, if you notice that you're paying more for your daily expenses. Actually, you know what? I'm going to just run with this for a minute, because there was another article I read this week that showed the savings rate for households is down significantly post-pandemic. Credit card debt is rising at an alarming rate. So if your credit cards are all now low balance and you've got a great credit score and you run all of your credit cards up trying to manage this financial hardship that you think is coming or you're starting to experience already, if your scores go down because your balances are high, which available balance to used credit is a significant portion of the scoring model, and I'll post this on the Facebook page too, the things that make up a credit score. Don't wait until your scores have gone down because your credit card debt has gone up. Or don't wait until your income is suffering because you're self-employed and you notice your billable hours are going down or your sales are going down. And I'm not speaking to you specifically because your question was HELOC versus cash out, but I'm speaking in general just for a moment. Because if you're really convinced we're in a hardship and you think you're going to grow vegetables in your backyard, do something now rather than wait. While your credit's strong, while you still have a ton of equity, now is the time to do it. You don't put your shutters up when you're in the eye of the storm. You prepare ahead of time. So if you are really navigating something that's pending in your future, sooner rather than later. Now to jump to your question. So on the surface, the HELOC's the no-brainer because it's interest only, typically for 10 years. Then it'll convert to a 10-year loan. There are usually very, very low, sometimes no fees to get into it. And the payment typically, or the interest rate rather, typically starts pretty low. The downside to a HELOC is it fluctuates. The interest rate moves with prime. And the bank can not call, as long as you're not in default, they can't call it due. But they can close it or reduce it based on market trends. So if equity starts to dry up, they can pull your credit limit back, and that might impact what you're trying to do. And then the cash out refi, obviously, rates are in the 5s. I don't know how that works for you, but the benefit is 30-year fixed rate, one time, and you're done. You're not looking back. They can't ever come and take that money away from you if values go down. So I tried to rush through that at the end because of the music. We're running into a 2-minute break. We'll be right back with you on the other side of this to take more of your questions. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallygreatagents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallygreatagents.com, www.reallygreatagents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. You are listening to the Mr. Mortgage Show, and if you have questions and want them answered right now, just call or text them to 561-291-8569. That's 561-291-8569. That is the Anytime hotline, and if you call it during the week, that'll push to my office. So one more time, 561-291-8569 is the easiest way to get your questions on the air. Or if you're tentative and you don't want to talk to us and you don't like texting, just shoot an email via the website, mr.mortgage, never a .com. Just type in mr.mortgage and fill out your question in the Contact Us box. So, speaking of questions, this is my favorite part of the show. We're going to do a rapid round. I'm going to throw it over to Dom and see what we've got teed up.
Margot emailed us. Margot's asking, I'm helping my daughter buy a townhome. What is the minimum down payment for a first-time buyer? Can we get a better rate if you put more down?
Hey, that's a great question, Margot. Kudos for thinking a bigger down payment will get you a better rate. And sometimes it will, but it's usually not until the down payment exceeds 25%. It's usually right around there. And it's credit score specific too. But to answer your question, typically 3 to 3.5%. So there are conventional loan programs that will let you borrow 97% of the purchase price, and FHA, which is a big program that a lot of first-time home buyers utilize, requires a 3.5% down payment. And you, as the mom, can always gift the closing costs. So hopefully that helps. But figure 3 to 3.5% plus closing costs. And if you have questions about that, just give us a shout during the week. So what else do we have, Dom?
Andy sent a text. I listened to your podcast about the seller buying down my rate. Can you explain this idea?
Hey, Andy, you, my man, win a prize. And I wasn't going to give a prize. That just, I'm excited because somebody listened to the podcast. And that episode that you're talking about is something that we just started doing this week. So I'm super excited that you found it. So each day we're doing what we call the daily dose. So you hear me on Saturday mornings. I'm here for an hour with Dom, and we're answering a load of questions. But once a day, we take one specific question or one specific topic and just go deeper. It's usually 5 to 10 minutes, and we cover one topic, and that is going out at themrmortgageshow.com. That's the podcast page. And Monday through Friday, there's a daily dose, and then each weekend we take the show. We record it while we're doing it. It goes up as a podcast also. So, man, thanks so much for mentioning that. I'm super excited. And I'm not kidding. I'll send you a Starbucks card if you text me or email me your address. So super excited about that. But to answer your question, that example that I used in the podcast was specific to a real situation. So I still have the numbers fresh in my mind. Purchase price of the property was $465,000. And the buyer had negotiated a $450,000 purchase price. Now, the cool thing was we talked before. This is an agent I do a lot of business with. So she always gives me a chance to best use the discount. That's what I like to say. So there's a $15,000 discount in this offer to buy. What's the best way to use it? Is it to pay $450 for the property? Or is it to take that $15,000 and use a seller contribution and apply it towards closing costs or third-party fees? Here's the cool thing they decided to do. This is their forever home. They're never looking back. It's in the school district. They're super excited. It's everything they've wanted. They want to raise their kids here. So we determined that a $465,000 price with a $15,000 seller contribution, and then using that $15,000 or at least a large portion of it to buy the interest rate down made the most sense. And I'm going to explain how this worked. A $450,000 purchase with a 10% down payment leaves a $405,000 mortgage at 5.5%, which is the rate of the day at the recording of this. A monthly payment, principal and interest is $2,300. Now, if we leave that sales price at $465,000, 10% down payment leaves a $418,500 loan. So a 4.5% interest rate on $418,000 is $2,120 a month principal and interest, or a savings of over $180 a month. So for them, that was significant. It made it easier for them to qualify. They have a 4.5% rate for the life of that loan. They're thrilled. They're not looking back. And I know, I see you. I see you out there at the end of the bar with your second cup of coffee at my favorite breakfast spot. You're saying, yeah, Mark, but they're paying $15,000 more for the property. How does that make sense? It makes sense because in 80 short months, which is about 6.5 years, that monthly payment savings offsets that $15,000. So for them, they plan on being there longer than 6.5 years, and they get the forever interest rate that they were looking for. So hopefully that helps explain it. But yeah, if you have further questions, check out the podcast. Go to the MrMortgageShow.com and check out the daily dose about seller contribution. But let me keep this rolling and throw it over to Dom.
We have a text from Chandler. Can friends buy a house together? My bestie and I rent together now and both want to own if this is possible.
Hey, Chandler, that's a great question. Do you think you're going to stay besties if you buy together? I'm just kidding. I'm kidding. But it is something to consider. So, but first, let me say, yes, you can buy together. No problems. We see it often. And actually, I think as we continue to move into this environment that we're in with housing prices kind of holding their ground at these all-time high levels, we're going to see more and more of this. But to answer your question, two friends can buy a property together. It can be both your primary. The things you're going to want to have kind of worked out and, discuss is what happens if your life changes or her life or his life, whoever the bestie is, changes, and one of you wants to sell and the other doesn't. I mean, just talk through those circumstances so you have a strategy together. But I commend you for figuring out a way to jump into homeownership, because even with your bestie, it makes sense to be building equity instead of paying off your landlord's mortgage. So hopefully that helps. I'm going to throw it to Dom for another question.
Donna sent this one. I'm getting divorced and I'm moving out. I don't want to rent. Our current mortgage is in my name. Can I get a mortgage on a primary residence now? She's getting the house. I'm just trying to figure out my next step.
Hey, Donna, that's a great question. So here's the thing. If you're getting divorced and you've already agreed that he's keeping the property, you're moving on, the only challenge is that until you're divorced, he is going to have to sign a document that waives his rights to your property as a marital asset because of the laws of real estate and marriage in Florida. There is a document. It's a simple process. I would talk to the attorneys about having that drafted. And if, all of this is amicable, it makes sense for you to buy if you can, rather than rent and then have to buy later. But there is a document that waives the one spouse's right to the new purchase. And if you need help with this, give us a call. And I share this only because divorce lending is a sensitive space. My partner is divorce lending certified. I don't think she'll mind me saying this. She's been through it a few times and has learned her way through the process, and then made it her mission to get certified and really understand the space well. There's a lot of compassion and empathy required, and it's not about negotiating to get you more out of the deal. It's just about helping with the mortgage component so both of your goals are met moving forward. But unless your husband's willing to sign that away, his right to that new property, you're going to have to wait until the divorce is final and the marital settlement agreement is issued. But there is a way to do it. It's a simple procedure. It's one document. The attorneys can help with it. And if you have questions, I welcome the opportunity for my team and I'll let you talk directly to my partner because she's awesome with that. But you hear the music. That means Dom and I are going to roll into a very short break. In 2 short minutes, we're going to be back for more of your questions. And stick with us. We'll be right back with you.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark Eitel and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. This is the Mr. Mortgage Show, and each week we strive to give you the information you need to make better real estate and mortgage decisions. So the number to get your questions on the air is 561-291-8569. Dom will get you squared away and get you on the air. Hey, I want to share one quick thing that I read this week, and I'm not too proud to admit that I scroll through Facebook once in a while. And I think it was a meme. I don't know who I can attribute this to, but I read that if someone is willing to give you their time, they're giving you a portion of their life they'll never get back. So don't waste it. And it's my hope that each week we give you something that was worth the time that you're willing to share with us. So in that spirit, we're going to keep answering your questions and hopefully giving you the good information that you need to get your mind around where we are real estate and mortgage wise. So speaking of questions, I'm going to keep this rolling and throw it over to Dom for another one.
All right. Jerry left us a voicemail during the commercials. Jerry's asking, can my dad be a co-signer on my mortgage application if he lives in New York? I'm not sure if this makes sense. I live and work here, but he's in New York.
Hey, Jerry, that's a great question, and it makes perfect sense. So, yes, Dad can be a non-occupying co-borrower. You're going to apply. He's going to be the co-borrower. We're going to use both of your incomes, both of your assets to qualify you. So make sure that dad has the income necessary to offset the asset portion of his application, because if he's retired and he's unable to show income, but he carries a lot of debt for whatever reason, you might be inheriting that debt. So that is a strategy that we use it often. Non-occupying co-borrower is the status that dad would apply with you on your application. And yes, it does not matter that he is in New York. That's still doable. So hopefully that helps. Again, I encourage you to call us during the week if you have more questions. But I'm going to throw it over to Dom to see what else we have.
A question from Alex. How long do I have to be in my current house before I can rent it and buy another one? I've heard 2 years.
Hey, that's another great question. There are a lot of people who employ that strategy, right? You'll buy your house, you'll live there for a couple years, you'll sometimes refinance it, pull some cash out, and go buy another property, keep property one, and turn it into a rental. So I used that story on purpose because the cash out is the caveat. If you've done a cash out refinance, you're going to want to stay. I don't know, want to or not, it doesn't matter. A lot of lenders are going to require that you stay in that property for a year before you make that move. If you haven't refinanced and pulled cash out, then some lenders will allow that move in as little as 6 months. But I would plan 12 to 24 months to play it safe. If there's a specific lender or a specific property you want me to research for you, I'm happy to do it. But you mentioned 2 years in your question. That's a safe rule of thumb. Just know that clock starts again on a cash out refinance. A rate and term refinance, not so much, but a cash out refi is going to start that clock over. So I hope that helps. I know we've had some really great questions this week. I always appreciate your questions. And I know by the spirit of the questions, we got a lot of people that are, sitting on the sidelines wondering if it's the time to jump in. And I still encourage you to watch supply and demand, watch the unemployment rate, and pay attention to the overall economy for sure, but don't get wrapped around the axle with headlines, because the headline is only meant to grab your attention. It's not giving you the whole story. And as you hear me each week dive into these headlines and deeper into the article, most of the time the headline doesn't even represent the data. So anyway, I hope you enjoyed this week's show. If you have, please share the show. We're always trying to build the audience. We like as many questions. We want to help as many people as possible. Share the show. You can check out the replays at themrmortgageshow.com, or the Facebook page is a great resource for all the articles that Dom and I use during the week. Go to Facebook and search The Mr. Mortgage Show on Facebook, and you'll see all the data. And lastly, the website is www.mr.mortgage. That's mr.mortgage. Nevera.com. We will be back right here, same time, same station next week. Have a great week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages, right here on The Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.